You know what's fascinating? While everyone's watching the stock market hit new highs and celebrating their portfolio gains, there's a completely different story unfolding in the precious metals market that almost nobody is talking about. And if you miss what's happening in the next 12 hours, you might look back on this moment with serious regret. Let me paint you a picture of what's actually going on right now. Gold just cleared $4,400 an ounce. Silver hit $69. These aren't just numbers on a screen. These are alarm bells ringing so loud that central banks around the world are scrambling to position themselves before the general public catches on. But here's what makes this moment different from every other time gold and silver have rallied. This isn't about fear. This isn't about a temporary flight to safety. This is about a fundamental restructuring of the global monetary system that's happening right under our noses, and the window to position yourself advantageously is closing faster than most people realize. Think about what central banks have been doing. For the third consecutive year, they've purchased over 1,000 tons of gold. Not 900 tons. Not 800 tons. Over 1,000 tons. These are the same institutions that spent decades telling us gold was a barbarous relic, that it had no place in a modern financial system. Now they're buying it at a pace we haven't seen since the early 1970s, right before the last great monetary reset. Why? What do they know that they're not telling us? Let me take you inside the mechanics of what's actually driving this move, because it's not what the mainstream financial media is reporting. They'll tell you it's about inflation hedging or geopolitical uncertainty. Those are factors, sure, but they're missing the bigger picture. The real story starts with something called the COMEX. That's the commodity exchange where gold and silver futures are traded. For decades, this market has operated on a simple principle. For every 100 ounces of gold that trades on paper, there might be one actual physical ounce in a vault somewhere backing it up. It's a fractional reserve system, just like banking, and it's worked perfectly fine as long as nobody asks for physical delivery. But something changed recently. The ratio of paper gold to physical gold that's actually available for delivery has stretched to levels that would make your head spin. We're talking about claims on physical metal that exceed available supply by margins that simply aren't sustainable. And the people who understand this system, the big institutional players, they're starting to ask for delivery. When you ask for delivery on a futures contract, you're essentially calling the bluff of the paper market. You're saying, I don't want your cash settlement, I want the actual metal. And when enough people do this simultaneously, the whole structure starts to crack. Here's where it gets really interesting. The London Bullion Market Association, the LBMA, which handles the majority of global gold trading, recently had to admit something remarkable. Their vaults, which are supposed to hold the physical gold backing all these paper claims, are seeing drawdowns at rates they haven't experienced in modern history. Gold is leaving London, it's leaving New York, and it's going east. China and India aren't just buying gold, they're vacuuming it up. But they're doing it quietly, through channels that don't show up in the official statistics until months later. By the time the World Gold Council publishes their quarterly demand reports, the metal is already gone, already in vaults in Shanghai and Mumbai, already out of reach of Western markets. Now, let me tell you a story that illustrates exactly what's happening. Back in 2008, during the financial crisis, there was a brief moment when the paper price of gold actually diverged from the physical price. If you wanted to buy a gold futures contract, you could get it at one price. But if you wanted to buy actual physical gold coins or bars, you paid a significant premium. The market was telling you that paper promises and physical metal were not the same thing. That divergence lasted a few weeks before the system stabilized. But what we're seeing now is different. The premium for physical metal over paper has been persistent, growing, and spreading across multiple markets simultaneously. In India, gold is trading at premiums that would have been unthinkable a year ago. In China, the Shanghai Gold Exchange price consistently runs above the London Fix. These aren't temporary dislocations. These are structural breaks in the market. And silver? Silver is even more interesting because it's not just a monetary metal, it's an industrial metal. Every solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. The green energy transition that governments around the world are mandating isn't optional for silver demand. It's locked in, committed, already in motion. But here's the problem. Silver mine production peaked years ago. The easy deposits have been found and exploited. What's left requires more energy, more capital, and more time to extract. Meanwhile, above-ground stockpiles, the silver that's sitting in vaults available for industrial use. Those stockpiles have been drawn down to levels that would shock you if you saw the actual numbers. The Silver Institute, which tracks these things, has been warning about supply deficits for years. But their warnings have been academic, theoretical. Now we're seeing the physical manifestation of those deficits in the price action. When silver moves from $30 to $69 in a matter of months, that's not speculation. That's the market screaming that there isn't enough metal to meet demand at the old price. Let me give you some context about what these price levels mean historically. In 1980, gold hit $850 an ounce. Adjusted for inflation, that's over $3,000 in today's money. Silver hit $50, which is about $170 adjusted for inflation. We're not at those inflation-adjusted highs yet, not even close. But the trajectory we're on suggests we might get there faster than anyone expects. But here's what's different about this cycle compared to 1980. Back then, the move was driven primarily by inflation fears and the Hunt brothers trying to corner the silver market. It was a speculative blow-off top that crashed just as dramatically as it rose. This time, the fundamentals are completely different. We're not dealing with speculation. We're dealing with central banks diversifying away from dollar reserves. We're dealing with BRICS nations actively working to create alternative payment systems that bypass the dollar entirely. We're dealing with physical supply constraints that can't be solved by simply printing more paper contracts. When Russia was sanctioned and had its dollar reserves frozen, every central bank in the world took notice. If the United States could freeze Russia's reserves, they could freeze anyone's reserves. Gold can't be frozen. Gold can't be sanctioned. Gold sitting in your own vault is yours, period. That realization has fundamentally changed how central banks think about reserves. Now, I want to take a brief moment here because this is relevant to a lot of people watching. If you're sitting on retirement accounts worth $100,000 or more, there's a free guide in the description about how gold IRAs work. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth looking at if you're thinking about diversification. But let me get back to what's happening in the market right now, because the timing of this move is critical. The technical picture on gold is showing something remarkable. Every major resistance level that analysts thought would cap the rally has been blown through like it wasn't even there. 2,700 was supposed to be strong resistance. Gold went through it in days. 3,000 was supposed to be a psychological barrier, barely slowed down. Now we're above 4,400, and the momentum is actually accelerating. When you see price action like this, when you see a market that refuses to pull back even when it's technically overbought by every traditional measure, that's telling you something important. It's telling you that there are buyers who don't care about the price. They care about getting the metal. That's not normal market behavior. That's panic buying disguised as steady accumulation. And the commercial traders, the big banks and institutions that typically short gold to hedge their positions, they're not fighting this rally the way they usually do. Their short positions have been dramatically reduced. Some of them have actually flipped to the long side. When the smart money that usually bets against gold starts betting with it, you need to pay attention. Let me tell you about what happened in 2011, because there are some interesting parallels. Gold ran from around $700 to $1,900 in about 3 years. Everyone said it was a bubble. Everyone said it couldn't sustain those levels. And they were right for a while. Gold corrected back to around $1,200 and stayed in a bear market for years. But here's what's different now. In 2011, central banks were still net sellers of gold in many cases. The dollar was still unquestionably dominant. China wasn't openly challenging the dollar system. The BRICS didn't have serious alternative payment mechanisms in development. The world was a different place. Today, every one of those factors has reversed. Central banks are aggressive buyers. The dollar's dominance is being actively challenged. China has been building gold reserves in yuan-based payment systems for years. The BRICS are expanding and creating their own financial infrastructure. The geopolitical landscape has fundamentally shifted. And here's something most people don't realize. When gold was at $1,900 in 2011, the total global money supply was a fraction of what it is today. The Federal Reserve's balance sheet was under $3 trillion. Today, it's over $7 trillion. The amount of currency in circulation globally has exploded. So even if gold just maintained its purchasing power relative to the expanded money supply, it should be trading significantly higher than it was in 2011. But it's not just about money supply. It's about trust. The entire financial system runs on trust. Trust that your bank deposits are safe. Trust that your government bonds will be repaid. Trust that the currency you're holding will maintain its value. And that trust is eroding in ways that are hard to quantify but impossible to ignore. Look at what's happening with government debt levels. The United States is running deficits that would have been considered catastrophic a decade ago, and now they're just accepted as normal. Japan's debt to GDP ratio is over 200%. Europe is dealing with structural problems that have no easy solutions. These aren't temporary issues that will be resolved with a few years of fiscal discipline. These are systemic problems that will take decades to unwind, if they can be unwound at all. And the only way governments can manage these debt levels is by keeping interest rates artificially low and allowing inflation to erode the real value of the debt. That's not a conspiracy theory. That's basic economics. When you owe more than you can ever realistically repay, you inflate your way out of it. And when governments inflate, gold goes up. But here's where the 12-hour timeline comes in. Markets don't move in straight lines forever. There are moments of opportunity when the setup is perfect, when all the factors align, and when the risk-reward is heavily skewed in one direction. This is one of those moments. The technical setup is showing extreme momentum. The fundamental drivers are all pointing in the same direction. The institutional positioning is confirming the move. And most importantly, the general public still isn't paying attention. When your neighbor starts asking you about buying gold, when mainstream financial advisors start recommending precious metals, when gold becomes the lead story on the evening news, that's when you know the easy money has been made. We're not there yet. We're still in the phase where informed investors are positioning themselves ahead of the crowd. But that window is closing. The price action over the next 12 hours, the way the market responds to current levels, will tell us whether this is the beginning of a sustained move higher, or whether we're due for a consolidation. Here's what I'm watching specifically. If gold can hold above 4,400 through the next trading session, if it can consolidate at these levels without a sharp pullback, that's extremely bullish. It means the buyers are still in control. It means the momentum hasn't exhausted itself. It means we're likely going significantly higher. Silver is even more critical to watch. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. It's moved from over 80 to 1 down to around 63 to 1. Historically, when this ratio gets down to the 50 to 60 range, it often signals that silver is about to outperform gold dramatically. And if silver starts to really run, if it breaks through $70 and heads toward 80 or 90, that's when things get really interesting. Because silver is a smaller market than gold, it doesn't take as much capital to move the price. And when momentum traders and retail investors start piling in, silver can move in ways that seem almost irrational. I want to tell you about what happened in 2021 with the silver squeeze movement. A group of retail investors on social media decided they were going to try to squeeze the silver market by buying physical silver and silver futures. The price of silver jumped from around $25 to almost $30 in a matter of days. The movement didn't ultimately succeed in breaking the market, but it showed something important. There's enormous latent demand for silver that can be activated very quickly. Now imagine that same dynamic, but instead of just retail investors, you have industrial users scrambling to secure supply. You have central banks diversifying into silver as well as gold. You have investment funds that have been underweight precious metals for years suddenly trying to catch up. The potential for a real supply squeeze is very real. And here's the thing about supply squeezes in physical commodity markets. They don't resolve quickly. You can't just print more gold or silver. You can't increase mine production overnight. It takes years to bring new mines online. So if we do get into a situation where physical demand exceeds available supply, the only way the market can clear is through price. Significantly higher price. The people who understand this, the people who have studied previous commodity bull markets, they know that the biggest gains often come in the final phase of the move. Gold went from around $400 to $850 in the last year of the 1979 to 1980 bull market. That's more than a double in 12 months. Silver went from around $10 to $50 in the same period, a 5 times move in a year. I'm not predicting that we'll see moves of that magnitude, but I am saying that the setup we have right now has similarities to previous periods where precious metals made explosive moves. And if you wait until those moves are obvious to everyone, you'll be buying at much higher prices. The question you need to ask yourself is this: what's your downside if you're wrong? If gold and silver pull back from here, if this rally stalls out and we get a correction, what's the worst-case scenario? You own physical assets that have held value for thousands of years. You own metals that central banks are accumulating. You own commodities that have industrial demand supporting them. Compare that to the downside of being wrong the other way. If this rally continues, if gold goes to $5,000 or $6,000, if silver goes to $100 or more, and you're sitting on the sidelines, how will you feel? The opportunity cost of missing a major move in precious metals is significant. And here's something else to consider. The correlation between precious metals and traditional financial assets has been breaking down. There was a time when gold and stocks moved together, when they both responded to the same economic factors in similar ways. That correlation has been weakening. We're seeing days where stocks sell off and gold rallies. We're seeing gold make new highs while bonds are under pressure. This suggests that gold is starting to trade more as a monetary asset than as just another commodity. When gold decouples from traditional risk assets, when it starts moving based on its own fundamental drivers rather than just following the stock market, that's a sign that something important is changing in the financial system. It's a sign that investors are starting to question the assumptions that have underpinned markets for decades. The assumption that central banks can always print their way out of problems. The assumption that government debt doesn't matter as long as you can service the interest payments. The assumption that the dollar will always be the world's reserve currency. These assumptions are being tested in real time, and the outcome of those tests will determine the financial landscape for the next generation. Now, I want to be clear about something. I'm not saying you should panic. I'm not saying you should liquidate everything and go all in on precious metals. What I am saying is that the risk-reward setup right now favors having meaningful exposure to gold and silver, whether that's physical metal, whether that's mining stocks, whether that's ETFs or futures. The specific vehicle matters less than the decision to participate in what could be a historic move. The 12-hour timeline isn't arbitrary. Markets move in waves. They have periods of consolidation followed by periods of rapid movement. We're in a period of rapid movement right now. The momentum is strong. The fundamentals are supportive. The technical picture is bullish. But momentum doesn't last forever. At some point, this market will need to pause and digest these gains. The question is whether that pause happens at $4,500, or at $5,000, or at $6,000. Nobody knows for certain. But what we do know is that the longer you wait to make a decision, the less favorable your entry point becomes. Every day that gold makes new highs is a day that you're buying at a higher price if you decide to get in later. And here's the psychological trap that catches most investors. They watch gold rally from $3,000 to $4,000 and think, it's too expensive now, I'll wait for a pullback. Then it rallies to $4,500 and they think, it's definitely going to correct now, I'll wait. Then it's at $5,000 and they're paralyzed, unsure whether to chase it or wait for a correction that might not come until much higher levels. The investors who make money in bull markets are the ones who recognize the trend early and stay with it. They don't try to time every wiggle. They don't wait for the perfect entry. They understand that being in the market during a major move is more important than getting the absolute best price. Let me tell you about a conversation I had with a mining executive recently. This is someone who's been in the industry for 30 years, who's seen multiple boom and bust cycles. He told me something that stuck with me. He said, the gold market is like a coiled spring right now. All the energy is building up. All the pressure is increasing. But most people can't see it because they're looking at the wrong indicators. What he meant was that the traditional metrics people use to value gold, things like real interest rates or inflation expectations, those metrics are missing the bigger picture. The real driver of gold prices right now is a loss of faith in the existing monetary system. And you can't quantify loss of faith with a formula. You can only see it in the actions people take. Central banks buying record amounts of gold is an action. China and Russia settling trade in yuan and rubles instead of dollars is an action. The BRICS nations developing alternative payment systems is an action. These aren't theoretical concerns. These are concrete steps being taken by major economic powers to reduce their dependence on the dollar-based system. And when that system starts to crack, when the dollar's dominance begins to wane, gold is the asset that benefits most directly. Because gold is the only asset that isn't someone else's liability. It's not a promise to pay. It's not backed by a government or a corporation. It's just gold. And that simplicity, that lack of counterparty risk, becomes incredibly valuable when trust in institutions is declining. The next 12 hours will show us whether the market has the strength to push through to new highs or whether we're due for a pause. But regardless of what happens in the very short term, the longer-term trajectory seems clear. We're in the early stages of a precious metals bull market that could run for years. The fundamentals are in place. The technical setup is favorable. The institutional positioning is supportive. Your decision isn't whether gold and silver will go higher. Your decision is whether you want to participate in that move or watch it from the sidelines. And that decision, that choice about how to position yourself, that's what you need to make in the next 12 hours. Because once this market really starts to run, once the momentum becomes obvious to everyone, the opportunity to get in at reasonable prices will be gone. Think about what you want your financial position to look like a year from now. Think about how you'll feel if gold is at $6,000 and you didn't take action when it was at $4,400. Think about the regret of missing a major move because you were waiting for perfect conditions that never materialized. The market doesn't give you perfect conditions, it gives you opportunities. And this is one of those opportunities. The setup is there, the timing is right. The question is whether you're going to act on it or let it pass by. Because 12 hours from now, the market will have moved, prices will be different, the opportunity will have evolved, and you'll either be positioned for what comes next or you'll be wishing you had been.